Be Wealthy and Smart, episode 1182.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about different income sources that are available to you. Now, I've been getting a lot of questions about where can you put money for savings, where can you put money that's safe, that isn't at risk with the stock market. But before I talk about where these places are, I want to talk about your motivation for wanting to know. Is your motivation that we had a bear market last year and you're wishing that you had done that before the bear market and you're doing this in hindsight? Because sometimes that happens where people do things in hindsight, wishing they had done it proactively. And now that the market has already dropped by 30%, they are going into some sort of safe investment that doesn't have fluctuations. But if some of that money belongs in growth-oriented vehicles, it should stay in the market so that you can recoup your losses and it will rebound and continue to grow over time. So think about, first of all, what is your goal for the money? Is your goal for the money to have it grow? If your goal is to have the money grow over time, then moving it into something that won't fluctuate right now because you want to feel, quote, safe, might be the absolute worst time to do that. Remember, most people are extremely pessimistic right now, which is usually a contrarian indicator, and the market has already rebounded very strongly since the October lows, and I believe we'll continue to see that. But we have to take that long-term perspective. So if you want your money to grow for 3 to 5 years or more, consider leaving it in the stock market. However, if you've sold a property, if you have savings for a down payment on a home, if you have need for money within 6 months or less, you probably need to have a safe place to put it. And if that's the case, that's what we're going to talk about today. Another thing that happens is people talk with me about retirement, and they're starting to think about how much income are they going to have in retirement, how do they plan for that, what kind of income sources can generate income for them in retirement, and so they're looking for these income sources that are safer. When you're looking at retirement planning, your different income sources are going to come from things like Social Security, maybe a pension if you have one, a 401k or an IRA, or some other sources of income. And in general, when you're in retirement, the amount of income that you want to take is about 3 to 4%. That's what studies have shown is the right amount of income so that you don't run out of money. So taking a 3 or 4% annual income out of your retirement plan won't guarantee that it will last indefinitely, but that is a level that's a guideline to help that income last indefinitely. So if you had $1 million in your retirement plan and you were taking 4% out per year, that would be $40,000 of income. If you had $2 million in your retirement plan, 4% would be $80,000 a year of income. So it's a function of how much you have in your retirement plan at about 4% to safely take out each year, and that's approximately the amount of income you could have. Conversely, if you had $500,000 in your retirement plan at 4%, that would be $20,000 a year of income. So using a 3 or 4% average rate of being able to take income out of your retirement plan is a good thing to do. And that will help you estimate what your future income can be, because you can just multiply 4% times whatever's in your retirement plan and then add your Social Security number on top of that, and that gives you a pretty good idea of what your annual income could be in retirement. All right, so let's talk about some income sources. One of the easiest sources that I use personally is my Fidelity Government Money Market, symbol SPAXX. This is because I have a Fidelity brokerage account, and it is standard in my account that Fidelity uses this as their money market. It's currently yielding about 4.48% annually, which is a decent rate. and it is a money market, so it is going to fluctuate based on where rates go. I believe rates are going to trend lower between now and the end of the year. We might have one more rate hike here coming up at the Fed meeting in May, but we may not. And later, I believe we will see inflation coming down so much that the Fed will be able to lower interest rates. So rates will probably tend to trend lower later in the year. Just expect that these rates are going to fluctuate with the market, so it's not going to stay at 4.48%. That's just where it is today. If rates go up, it could go up. If rates go down, it could go down. But your principal is not going to fluctuate. Just the interest rate paid on your money will fluctuate. The second income source that I like right now are Series I savings bonds. The I bonds are currently yielding 6.89%. It's a fixed rate that changes every 6 months based on inflation, and that rate is calculated twice a year in November and May. So we're coming right up on the next month's calculation, and the rate could either go up if interest rates go up, or it could go down if interest rates go down. But currently, it's at 6.89%. It's guaranteed that the interest rate will never drop below zero. So unlike Europe, we won't have negative interest rates here, at least not in Series I savings bonds. When it comes to tax, on a Series I savings bond, you owe federal tax, but you don't owe state tax, even if your state requires state tax. So for example, I live in California, I would pay federal tax on the interest on my Series I savings bonds, but I would not pay California state tax on it. The minimum amount to purchase a bond is $50. You can also buy them in increments of $100, $200, $500, or $1,000. And all you need to do is open a Treasury Direct account by going to treasurydirect.gov, treasurydirect.gov. In any one calendar year for any one Social Security number, you can buy $10,000 of electronic I-bonds and $5,000 of paper I-bonds with your tax refund. So you are limited to how much you can own in these bonds. That's the one downside. But you can cash them in after 12 months. However, if you cash in the bond in less than 5 years, you lose 3 months of interest. So for example, if you cash in the bond after 18 months, you get the first 15 months of interest. The next source of income I'd like to talk about are high yield funds. Now, high yield funds are typically what are known as junk bond funds. Those are low rated corporate bonds of corporations that don't have the greatest balance sheet. So there is more risk that they could go out of business. And that's why they're paying such a high yield on their bonds, because they're borrowing money, but they have to pay higher rates in order to borrow money because their credit is not as good, because their balance sheet isn't as good. So these are riskier type investments. I would caution you to not invest too much in high yield bonds. You can put a small slice of your portfolio in there, but this is a mistake that a lot of people make. They're reaching for yield and they're so desperate for a higher yield that they go with these riskier bonds, and then some of those bonds default and they lose money. So that's not a good strategy. That's not where you want your safe dollar. So be very cautious with high yield bonds and high yield ETFs. The next income source is the Dividend Aristocrats Exchange Traded Fund, or ETF, symbol NOBL, Noble, NOBL. It invests in S&P 500 companies, large companies that pay dividends, that have raised their dividends for 25 consecutive years, and many of these companies have raised their dividends for 40 consecutive years. Now, because it is attached to stocks, and these are stocks that are paying dividends, that means your principal is at risk in the stock market. But that can be a good thing over the long term as you get the performance of the stocks as well as the dividends that they pay. So for example, the Noble ETF has been around since 2013, and since inception, it's averaged 11.76% annually. That's a 5-year return of 10.73% on average, a 3-year return of 19.45% on average, but a 1-year return of negative 1.55% because we had a difficult year in the last 12 months. Year to date, through 3/31/23, it's up 1.8%, and in the last 6 months, it's rebounded quite nicely, up 15.57%. So again, your principal is fluctuating because you are invested in stocks, but they are stocks that have increasing dividends over the long term. So for a portion of your portfolio, this can be a very attractive investment and give you a growth opportunity at the same time. So whether you invest in a money market account or Series I savings bonds or high yield funds or dividend aristocrats or other dividend funds, these are some income ideas that can help you generate income going forward. Make sure that you understand what your objective is with whatever vehicle that you're choosing, and don't ever shop just based on what's paying the highest yield. That's a common mistake that green investors make, not one that I want you to make. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all of my podcasts are available on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more investment tips to grow your wealth. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.